Hello, accounting scholars. Welcome back. In our last video, we mentioned the concept of a scorecard and balanced scorecard, and as I mentioned to you several times through the beginning of the course, accounting is the international world or worldwide way to keep score. So an extension of that is something called a balanced scorecard, which essentially allows the translation of accounting information into financial and non-financial measures in order to determine the health of a company. It really is a holistic approach, and by holistic meaning that it takes into consideration the enterprise as a whole, both from a planning standpoint as well as from a evaluation standpoint. But what does the holistic approach mean, and how does this relate to specific perspectives of the business? There actually are four perspectives that are related to this holistic balanced scorecard. And those particular perspectives are named: number one, the financial perspective; number two, the internal balance scorecard perspective; three is the customer perspective; and four is the learning and growth perspective. Actually, that's kind of a cool performance indice because it actually measures and quantifies the investment the business is making in its people, for instance, in training. But let's start with the financial perspective. And the financial perspective, as you might expect, is all about numbers, and specifically ratios. The first one, that is one of the most important and used by investors outside the company as well as internal management, is the return on investment ratio. Return on investment ratio is simply net income divided by average total assets. And again, this is a good indicator of how the management is doing based upon the assets available to them. What kind of return is coming out of the money that is being put in? Now, the next one's an interesting one. This is a quick ratio, and it's really a ratio very similar to the current ratio that you studied in the first chapter, except it's a little more precise. And by that I mean the denominator of this particular ratio is cash plus short-term investments plus receivables. Those are asset categories that can literally be turned into cash in a few days, if not 24 hours. So that is really a good indicator of the liquidity and strength of a company, especially when you divide that by current liabilities or current debts. The next ratio is return on owner's equity. The owner's equity section, as you remember, reflects the amount of investment made by the owners of the business. And so this particular ratio is net income divided by average owner's equity. And the last measure of used in financial perspective for our conversation on this particular side is gross margin. And that is the relationship between gross margin and sales. And if you need a little refresher, gross margin is defined by sales minus cost of goods sold. that result divided by sales will give you a gross margin. A high gross margin percentage here is usually a very good indication of the profitability of the company, and that usually translates into a high net income percentage for the company. Okay, there are a couple other ratios that come into play here, and you certainly should be aware of those. These are ratios that actually you studied in the first chapter. You'll probably recall the current ratio, which equals current assets over current liabilities. I'm sure you'll recall the debt to equity ratio, which is total debt divided by total shareholders' equity. And last but not least, the return on sales ratio, which equals net income divided by sales. Okay, so that gives us a good overview of the financial perspective. Let's move on to the second balanced scorecard perspective, which is the internal perspective. So what is contained in these particular balance approach issues? First is the value added versus non-value added timeline. This is a lot of big words, but really all it really means is what is the customer response time? By customer response time, meaning from the time a customer places an order until the order is received. Very important to most businesses because it specifically relates to their cash flow, how quickly they get cash in and out, as well as their income. As you might reflect, you see this particular measurement in real life almost every day. For instance, if you go through the drive-thru at Wendy's or any fast food restaurant, they are very concerned about the time it takes them to receive an order from a customer in the drive-thru to the time that the customer actually gets that order and pays. That is a key measurement for them of value added versus non-value added time. Other perspectives relating to this particular area are activity ratios, and again, these measure various activities in the company and quality information. As you might expect, this is very, very important because if you're not monitoring or measuring the quality of your product, you can't prevent quality problems from occurring. You can't appraise whether quality problems are occurring. You can't determine whether there is an internal failure or whether there might be an external failure. As you might have heard, Tesla, which makes battery driven cars, has been a very popular stock because their cars have been selling very well. But last week, one of their batteries in cars that a customer had bought caught fire. And as a result of not catching or preventing that external failure, Tesla's stock fell by almost 30 or 40%. Okay, we are at 9 minutes and 27 seconds. Let's do one more slide. Let's talk about accounts receivable turnover. This is a measure of how fast you are paid if you extend credit to your customers. So the way this particular ratio is computed, it is sales divided by average accounts receivable. And then once you have that turnover number, you take that and you develop the next activity ratio, which is accounts receivable days, sometimes called day sales outstanding, and that equals 365 divided by the turnover number that you computed above. A second activity ratio is the cost of sales or inventory turnover, which is computed by the cost of sales divided by the average inventory. And here again, to get inventory days, you would take 365 divided by the inventory turnover. Again, this would measure how fast you are moving inventory in and out of your company from raw materials to a finished product, which again is a very important measure of activity. And the third one is the accounts payable turnover, which equals the cost of sales over the average accounts payable. You then do a similar calculation once you have the turnover number for accounts payable days, which equals 365 divided by turnover. And again, this is a measure of how fast you're paying your bills. Again, a measure of the health of a company. Creditors would be very interested in this particular. Okay, you guys have done a great job here. We are at almost 12 minutes, and we will end right here, and I'll see you tomorrow in class. Have a great day.